Hello there, it's David Roach. I'm here to talk about Silicone Valley Bank and what it means for you and for the world. I wanted to divide this into really four different parts. One is, how do banks collapse? The second is how this bank collapsed. The third is potential spillover effects. And the fourth is, what can stop that happening? So let's start with bank collapses. When do banks collapse? Well, there's several reasons, but here's three. When their assets are worth less than the liabilities, so that basically they are then insolvent. When the liquidity of their assets does not match the liabilities, for example, let us suppose that depositors decided to take their money out of the bank, but the bank could not sell its assets, so they were liquid. And then the liquidity crisis forces the bank to collapse. And the third effect is when the assets and the liabilities are of different duration. For example, if you have a bank which invests in 30-year bonds, but uses depositors' money to do so, then if long-term interest rates go up, the value of your assets will go down, and that will cause, of course, an insolvency problem because your assets will no longer match your liabilities, which are earning short-term current rates of deposit. So there are three reasons why banks collapse. Then, of course, there are a lot of other ones in history, like, for instance, the tulip mania or the technology mania. So on that happy note, let's have a look at what happened to Silicone Valley Bank. Well, it's very simple, really. Silicone Valley Bank was involved in the financing of startup technology companies, which by their very nature are highly long-term and very illiquid. And it funded itself with deposits. Now, those deposits principally came from the same startup companies. They therefore, on the face of it, were not covered by insurance deposit. At least they were only covered to a minimal extent, but that is not the real story. The real story is that they were very short-term. So the maturity mismatch was there. Now, what happened? The bank decided that it should invest the money put on deposit by all those startups with it, which exceeded the amount of money it had lent to those startups. It should put this money into mortgage bonds, long-term bonds. Now, as we all know, the rate of interest on long-term bonds has gone up a lot. So the valuation of those assets fell. And so the gap between the deposits, which are a fixed liability of the bank, and the assets gapped out. And at that point in time, something else happened. The depositors realized that there was something afoot. They started to take the deposits out of the bank, and the bank had to sell assets in order to cover the gap between what the depositors were taking out of the bank and the assets. And unfortunately, these asset values were no longer equivalent to the deposits in any case. So that caused the collapse of the bank. So that's what happened to SVB. Now, that's a pretty standard collapse based on a bank run, based on a mismatch of maturities, based on a mismatch of valuation between liabilities and assets. Now let's talk about the spillovers, which is the third chapter. How can this affect the world around the SVB bank? Well, for a start, the startups will not get the money back, not immediately anyway, and maybe not ever, but they're certainly missing their deposits, and the bank cannot meet its liabilities to pay off those deposits at the beginning. So that will impact, of course, all the startups, the people they employ, their ability to create technological innovation, and I can go on. But it doesn't only involve tech startups. It can involve, for example, tech investors in startups. So you have lots and lots of portfolio managers who only do this. They actually mix borrowings to the bank, which can also be SVB or a similar bank, and they invest in startups, which are long-term investments and highly liquid. And of course, now they are caught in exactly the same position as every other investor in startups. The startups are short of money, they may be illiquid. This means that the assets of the portfolio managers may be worth considerably less than what they have them on the books at. And this can create a ripple effect among portfolio managers and also closures and collapses. And then there are sectors which are not really directly involved in technology startups at all. Let's take stablecoin. Stablecoin has turned out not to be so stable after all. It's now down to 0.8 something to the US dollar, whereas it's guaranteed to be 1-to-1 to the US dollar because every stablecoin is supposed to be backed 100% by a US dollar. But unfortunately for stablecoin, a slug of the money received, for which it issued stablecoins, was invested in the Silicone Valley Bank, SVB. So it's not there anymore. So suddenly, stablecoin's assets are not equal to its liabilities, and the backing for stablecoin at 1-to-1 is now considerably less. So you've got a spillover into the crypto asset area, which is not the same as a spillover into technology startups. And then you have financial flows, which can flow between banks, Bank A lending to Bank B investing that in the securities of Bank C, which always get interrupted by the failure of any part of that chain of transmission. And the failure of SVB is a significant part of the chain of that transmission. Let me explain that. I'll put some flesh on that bare skeleton of bones. SVB's total balance sheet assets are about 200 billion US dollars. The total assets of the entire US banking system is about 23 trillion US dollars. And of the top 10 banks, about 13 trillion. So you might say, well, at 1% of total assets, what's the big fuss about SVB? Well, I'll tell you what the big fuss is. The big fuss is the theory of chaos, where the flapping of a butterfly's wings in Honolulu will create an earthquake in Turkey, God forbid. But the transmission mechanism is that if one part of the chain of international finance is not working, then it can create a hole in a successive and linked series of bank balance sheets, which lend, borrow, and so on from each other. And that gets transmitted into a contraction of credit, the so-called credit crisis. It can get transmitted by falling asset prices. And of course, it can get transmitted by a falling confidence among economic players, be they consumers or be they corporate sector or the financial sector. But they are all there. So in a broader economic sense, you have to look at SVB in terms of its impact on the wider surrounding economy in confidence, in the linkages of capital, and of course, in jobs and demand. Now, what are the offsets? Why do I think this is not going to happen like the great financial crisis? Why do I think we're not at the dawn of another great financial crisis? There are three major offsets, which is the fourth chapter of this analysis. First of all, since the great financial crisis, banks have been regulated and have learned a lot, and the authorities have learned a lot. Let us start with the authorities. They are used to dealing with financial crises. They know how to intervene. They won't intervene to save every single player who shouldn't be saved, but they can at least provide injections of liquidity which prevent an outright liquidity crisis, while it does not seek, or nor should it seek, to prevent the insolvent going bust. but their experience in preventing a liquidity crisis becoming a solvency crisis, which is the natural chain of events when you have a credit crisis, their ability to master the situation and do something about it, whether you're talking about the US authorities or whether you're talking about the European authorities or the Asian authorities, it makes no difference. They have all learned a great deal, and they're on their toes and they're onto this crisis early. The second factor is that banks, since the great financial crisis, have been obliged to hold what are called HQLAs. Now, in a world in which acronyms are the names of everything and make no sense, what this actually means is high quality liquid assets. So if you're a bank and you're lending to risky clients, and all clients are risky, but in various degrees, then you have to hold a proportion of those loans that you make. You have to hold them in high quality liquidity assets, which means really short-term sovereign bonds or short-term sovereign notes and things like that. Things which are definitely there. They're going to be paid off at maturity, and you're not going to be waiting for 30 years to get your money back. So that's what high quality liquidity assets are. Now, the reason they're so significant is because if you look across an array of banks, you will find that they are equal to 20% of total lending. That's a huge amount of money. If you consider that on the face of it, Silicone Valley Bank is about 1% of total bank assets, you're looking at high quality liquidity assets, which are probably equal to at least 100% or probably 140% of the more risky loans of banks, and certainly 20% of total loans. So you have a buffer, which is already built into the system by what we learned from the great financial crisis. And the final point is this: the capital ratios of banks, that is, the amount of capital which is on the balance sheet, on the liability side of this balance sheet, but which is not a liability, but which is a shareholder capital in a sense. That capital is now regulated by the BIS and by the Basel agreements in all the various stages, and is at the present time equal to about 16 to 18% of total bank balance sheets. Now, if you go back to the beginning of the great financial crisis, that was about 4%. That does not automatically provide a buffer against a liquidity crisis. You rely on high quality liquidity assets to do that. What this capital does is to provide a buffer against insolvency. Let's say the loans on the asset side of your balance sheet related to SPV and a number of other banks were 2%, and you got no money back, or maybe they were 3 or 4%. You still have 18% of capital to use up before that will become a solvency issue for the bank. So what I am saying is, one, authorities have got a lot cleverer at dealing with crises. Two, you have a big buffer to prevent a huge liquidity crisis, which is the high quality liquid assets. And three, you have a big buffer to prevent insolvency in the banking system as a whole, whether it is international or the US. So the bottom line of all this is, I think this is a very serious situation. I think it is not the last. We are in an environment in which tightening monetary policy was absolutely necessary to confront inflation, but leverage is very high throughout the financial system, and in particular throughout the low end in terms of quality of the corporate sector. So it is perfectly normal when you tighten monetary policy, you increase the cost of capital, that you are going to get casualties. It is a little like squeezing eggs. If you squeeze eggs, some are going to break. And that is exactly what is happening. But it is also normal. You have to avoid the spillovers and consequences in terms of the destabilization of the total economic system and indeed of the total financial system, as we've just been discussing. But the reality is that you cannot avoid this. You can do something about it when it happens. It is very hard to predict where it is going to happen, but it is going to happen again and again, during this period. I don't foresee the central banks as going backwards and starting to print money and kind of bail everybody out and start the whole cycle of excess credit, excess monetary creation and inflation again. I don't see that happening. I think the banks will continue to tighten monetary policy, but the days of 50 basis points increases in policy rates every month are over. You might see 2 more 25 basis points in America, and but basically it's going to be a slower pace and a more gradual pace of monetary tightening. But you will see other bank failures. But I think they will be reasonably local. They will not involve a major global player. They will have economic consequences in slowing growth in the United States, and longer term, of course, they have an impact on innovation. That will apply in many markets and many economies around the world. But I do not see the result of this as being uncontained. I think it will be contained to a relatively local level in terms of banks and technology, startups, and spillovers into areas like crypto assets. But it is not, you will be pleased to hear, provided I'm right, of course, which I normally am not, it is not the beginning of the greater than great financial crisis right now. Thanks for watching. I hope this brings you some tranquility to your thoughts, and I hope that my modest forecasts are correct.